following announcement has been paid for by the
Wealth Management Advisory Club. Hey everybody, it's the president of the Wealth Management Advisory Club, Jack Mitchell here. Welcome back to another exciting WMA Club meeting. Before we send you guys off to this awesome meeting you guys are about to watch today, a couple announcements on our end. All right, so first of all, I just want to say, guys, thank you guys so much for supporting us through our mega month that we had last month in March. I really was not expecting us to do a lot of events in March. In fact, even if I look right now on my, I gotta look how many events we did in March, which I think was the most we ever did in a month in this club. Oh my, we actually did, oh jeez, 28 meetings, which is absolute crazy. And that includes events, co-hosting events, crossover events. And we're just so blessed that you guys are able to support us throughout every single one of these meetings and events we're still having. So again, I just want to thank you guys from the bottom of my heart and from the entire e-board and myself. Thank you guys so much again for supporting WMA Club throughout all these years. So again, I appreciate it. Thank you guys so much. The second announcement. So obviously, you guys already know that our speaker today is Kevin Mahn from Hennion Walsh Asset Management. However, if everyone, after you most likely, has looked at their emails, we're the wise, read your emails, or probably looked at social media, you would probably realize that there was a shelter-to-place warning that was held as of, I think, 10 a.m. in the morning, and it actually just got released now. So he was supposedly supposed to come in person today, but due to this, he has decided not to come virtually, so unfortunately that is what it has to be. However, I will make it up to you guys. I will bring him back next semester, and it will be in person. So again, I will make this up to you guys because this was out of our hands. It was out of our control. So I apologize on our end that this had to happen, but we did not want to forfeit a meeting, and as the old saying goes, the show must go on. So we're still going to have it regardless. So that's that. The third thing, and actually, I'll just do a whole snippet announcement. We have a big announcement coming at the end of the semester. Yes, so I'm not going to reveal it now. My e-board and I are the only ones that know this announcement. But we will reveal this announcement at our last meeting of the 2023 spring semester, which will be on May 4th. So again, you better want to be there because it'll be a big, big, big announcement. So that is 3. 4. Since I really don't have anything else, oh wait, no, I have 2 more things to talk about. I am now going to go over with you guys the entire schedule for April and then the last 2 meetings we have in May, because quite frankly, we don't have a lot of meetings in May, we're only having 2. So I wish there was a way I can show you guys without me rambling on for a long time. Let me try something. Oh, there it is. Look at that. Okay, so the rest of the 2023 spring semester schedule, as I like to call it the home stretch, is going to look like this. So the first meeting for April is going to be Hennion Walsh Asset Management, the meeting you guys are about to watch today. Then Thursday, Advisors Capital Management, Carrie Carbonaro, CFP, certified, will be coming and speak to us in person. So again, obviously, please come out in person. If you're on the Forum campus, please come in person. You don't have you guys really have to dress business casual if you want. If you really do, go at it. We're really trying to help you guys out as much as we are. And I will say that meeting will basically be like, if you guys remember the meeting we had last semester with KPMG with Celeste Leon, it's going to be like that. And trust me, I am super excited for this meeting for Thursday, so I'm really excited to have her come in. Then April 11th, we're going to have Edward Jones come in, and I promise you guys, it will not be canceled again. Bob Capitel will be coming in to speak to us, so that will be on the 11th. Then on the 13th, New York Life, James Fiorello will come and speak to us. That'll be on the 13th. Then on the 16th, WMA Club and the FDU admissions program will be partnering up for the 2023 FDU Admitted Students Day event at the Metro campus. That will be at 10 a.m. to 2 p.m. at the Metro campus, not on the Forum campus because that was in March. It is on the Metro campus. You will have a chance to meet yours truly, the president of the WMA Club, along with my other e-board members like our VP, Gloria Petruska, our secretary, Kevin Ryan, our treasurer, Mitchell McPaul, and our social media manager, Lindsay Sparling, as well. So again, you're going to meet all of us, and we might be able to see you guys in the fall, maybe when you come to WMA Club. So then the 18th, we had the B Muse, Akiva M. Ellis, CFP certified, will come and speak to us. Then on the 20th, Grant Thornton, Mark Menard will come and speak to us. Then on the 21st, WMA Club and the FDU FPC with a bunch of other clubs that I am not going to run all their names down because, again, this video will be way too long then, so I'm just going to abbreviate, so I say multiple clubs. We'll be teaming up to bring you guys 2023 Devil's World. This will be an FDU Florham campus exclusive event. However, anyone in Metro, I am open the door for you guys. You guys want to come to that event? By all means, please do. Enjoy the fun. That will be at 1 to 5 p.m. on the Library Lawn area, so where the Monitor Center sits by, like, you see the orangery and then you have the Mahn, base of that whole big giant field of grass. That's basically what the Library Lawn is. And then Cross River, Phil Goldfeder will be coming in on the 25th, and this is actually geared towards you guys in Metro. He will be speaking in person at the Metro campus, and guess who else will be at the Metro campus? This guy. Yes, I will be there in person at the Metro campus for that meeting. It'll be an awesome meeting. Can't wait to see you guys all there in Metro. Can't wait to see how many people actually show up there because, you know, I'm always doing the attendance for the live streams and everything, so I'm very, very excited to see you guys there. Then the 27th, Barrister Wealth, Charles C. Weeks Jr., CFE certified, they come and speak to us. Then our final two meetings of the spring semester. Sorry, we were getting ahead of ourselves there. Is going to be Morgan Stanley, Christopher Sotomayor will be come and speak to us, and then the final meeting of the spring 2023 spring semester. UWorld, Janelle Brion Lopez. Many of you probably remember her because she has spoken to Beta Alpha Psi here at FDU, and if you remember last year, spring 2022, she has spoken to the WMA Club. And it's going to be very different because she will have someone else to be presenting with. Yes, yours truly is back at it again, presenting CPA and CFA review courses, this time under the UWorld banner. And I am very, very excited to be presenting this to you guys for the very first time under the UWorld banner. So I'm very, very pumped up for that. So that is our entire rest of our 2023 spring semester schedule. Again, please refer to that for the times, the location of the meetings. Obviously, Metro, you guys know the drill. Meetings on Tuesdays are at the Dickinson Hall, room at 70. Thursdays, Dickinson Hall, room 1104. Zoom is also optional, and our WMA Club socials as well. So again, I really want to ramble that on a lot because then the intro is going to go on way too long. So again, just leave it at that, abbreviated version. So enough of this. Oh, yeah, another thing. We are planning on our fall semester schedule. So at some point, probably the next 2 weeks, you guys are going to get an announcement about when our meetings will be for the fall semester. And I will not be revealing, we will not be revealing our speakers yet for that because we want to leave it a surprise for you guys. And I will give you guys a hint. Some of the speakers that will be coming to speak to us are new, and some you have already seen before. That's all I'm going to say. We'll let you guys figure out the rest. Finally, it is time to shout out to our sponsor. Yes, we're still doing our sponsors here at WMA Club because why not? So this week's meeting is sponsored by Chime. Are you tired of dealing with big banks that charge you ridiculous fees and offer poor customer service? Then it's time to switch to Chime, the mobile bank that is designed to help you take control of your finances and make banking easier and more affordable than ever. With Chime, you can enjoy a range of benefits that you won't find with traditional banks. You can access your money anytime, anywhere with their mobile app, and you never have to worry about hidden fees or minimum balance requirements. Plus, with their automatic savings feature, you can save money effortlessly and watch your savings grow without even thinking about it. At Chime, they're committed to making banking as easy and stress-free as possible. That's why they offer real-time transactions alerts so you could always stay on top of your spending, and their award-winning customer support team is always available to help you with any questions or issues you may have. But that is not all. No. When you sign up for Chime, you will also get a free, and I am not joking when I say this, a free Visa debit card that you can use to make purchases and withdraw cash from ATMs And with their Spot Me feature, you can even overdraft your account to up to $200 without incurring any fees. So what are you waiting for? Join the millions of satisfied Chime customers who are already enjoying the benefits of mobile banking. Sign up today and start taking control of your finances like never before. So, if you click the link in our link tree down below in the description of this meeting, or you go to our website, the official WMA Club website, not the one that FD Silver made, the one that we made, and you go to our sponsors page and click on Chime, you will be able to sign up for a free Chime account. And on top of that, you will be able to get a free Visa debit card. But that is not all. No. You will be able to earn $100 when you sign up. I am not lying. You will earn $100 when you sign up. Thanks to the WMA Club and to our sponsors, Chime. Again, I'd like to thank Chime for being today's sponsor of today's meeting. All right, I feel like I overdid the intro there, so I do apologize. So, if you guys are ready, I know I most certainly am ready. Let's get you guys off to the meeting.
And now, our feature presentation.
Going. All right. Hello, everybody. Welcome back to another Wealth Management Advisory Club meeting. Hope everyone had a relaxing weekend. Today, we have a very, very special guest. Some of you may remember this person because he did speak to not only our club, but to the Student Managed Investment Fund last semester. It is Kevin Mahn from Hennion and Walsh Asset Management. Just going to read a little bit about him, and then we're going to let him take over from there. So Kevin is a highly experienced and accomplished professional in the finance industry with over 2 decades of expertise in asset management and financial planning. He currently serves as the president and chief investment officer of Hennion Walsh Asset Management, a leading investment firm based in New Jersey. He is a sought-after speaker and commentator on financial markets, has been featured in various media outlets, including CNBC, Bloomberg, and the Wall Street Journal. He's also a regular contributor to Forbes, where he shares his insights on investment strategies and market trends. Aside from his impressive credentials, Kevin is also known for his dedication helping investors to make informed decisions and achieve their financial goals. He's committed to providing personalized advice and solutions to his clients and has built a reputation for his integrity, professionalism, and his exceptional advice. So guys, let's please make this entertaining as possible, ask a lot of questions. And with that, Kevin, I'm going to let you take it over from here.
Well, thank you so much, Jack, for that kind introduction and for inviting me to speak to you here tonight, as well as the entire group. I'll just make one slight correction. I've been on Wall Street now for 30 years, actually, as you could see from my gray hair. And I owe a lot of my success to my time at Fairleigh Dickinson University, just in terms of background, to put in perspective where I came from and where I am now. I did my undergraduate work at Muhlenberg College, graduated at Muhlenberg College back in 1991. I'm sure many of you guys watched March Madness and saw UConn win the national championship last night. Very proud of that fact, as my younger daughter is the senior at UConn. But during my freshman year at Muhlenberg College, it was the first year they introduced the three-point line in college basketball. So that should help give you a feel for just how old I am. After I graduated from Muhlenberg, I went to Fairleigh Dickinson University in Madison, New Jersey, at a graduate business fellowship. I worked in the academic advising department, and I also helped teach and proctor some of the economics courses on campus. At the end of 1993, I graduated with my MBA from Fairleigh Dickinson University and took a job working on Wall Street for Lehman Brothers. At that time, I accepted a role in a management training program that they had started for recent MBA graduates, and I was very fortunate to be able to rotate amongst many different operational, risk management, and trading desks to get a full perspective on the many different facets of what takes place at a major investment banking firm on Wall Street. I was very fortunate to work at Lehman Brothers for 11 years. I rose to the title of Senior Vice President there, Chief Operating Officer of Lehman Brothers Bank, and CAO of the High Net Worth Product and Services Division. Unfortunately, I was also in the buildings on 9/11. We lost our building that day. I was moved into the Citigroup building in Midtown Manhattan. And to put a little another dose of perspective into my background, I came into my office one morning and my secretary told me to wait outside because they were installing bulletproof glass that day in our offices. I went outside to grab a cup of coffee, only to find an Army tank parked outside the entrance to our building because they found blueprints from a terrorist organization, and that building was included as part of those blueprints. So I decided at that point in time, I loved what I did. I loved working on Wall Street. I loved the competitive nature of it. I loved helping individual investors and, quite frankly, working with math and being quantitative, but I wanted to do it somewhere else that was a little bit closer to home and that didn't necessarily involve a 2-hour commute each way. So I found Hennion Walsh, very fortunately, based upon a cocktail party I went to in Denville, New Jersey, where I met one of the partners' brothers of Hennion and Walsh. One thing led to another, and 6 months later, I joined the firm to help grow out their wealth and asset management division, ultimately starting the first ever, at that point in time, mutual funds of ETFs called the SmartGrowth Mutual Funds. Also, as you can see behind me here, the logo SmartTrust. We're one of the top 5 sponsors of UITs in the country, with 27 different strategies that we market to roughly 47,000 financial advisors across the country. And I've been here now at Hennion Walsh for the better part of 19 years, serving as their president and CIO, as Jack alluded to earlier. I'm also a contributor to Forbes. I'm a contributor to Seeking Alpha and Talk Markets. I appear in the financial media quite regularly. In fact, I'll be on CNBC's Squawk Box tomorrow morning at 6:10 a.m. with Joe Kernan and Andrew Ross Circuit and Becky Quick. If you're up that early, by all means, tune in. Later that afternoon, I'll be on Yahoo Finance. And then on Thursday, I'll be back on Fox Business News with Charles Payne around 2 p.m. If you don't catch me live, you can certainly follow me on LinkedIn. We generally post all of the media segments there as well. I was also fortunate to be able to be published in the Journal of Investing, the Journal of Index Investing. And again, I'm very pleased with where my career has led me to. And I think FDU laid the foundation for exactly what I am doing today. Unfortunately, I wasn't a part of an investment or a wealth management club while I was going to school. What led me in the direction of Wall Street, quite frankly, was I read the book by Michael Lewis, Liar's Poker. I was intrigued by the competitive nature of a Wall Street trading desk at that time, how it drew in athletes. Again, I was a short-term Division III college basketball player, but I truly appreciated that you get out of life what you put into it, and work ethic generally leads to success. And that was the path to success on Wall Street, at least as I understood it there. So everything that you guys are doing right now, being part of these groups, bringing in experts from across the field, networking, and understanding the different facets of what you can do on Wall Street is really going to position you for success. Hell, when I was back in college, I thought I wanted to be an architect at first. I can barely draw stick figures, but I read that book. I took that management training program at Lehman Brothers. I rotated among the various different divisions, and I ultimately found a home in wealth management after starting in risk management and later getting onto the financial advisory side of the business, developing financial plans and implementing investment strategies to help individual clients. And there's no better feeling than helping Mr. and Mrs. Smith achieve their financial dreams, whether that's retiring at the age of 65, putting their children through college, being able to afford a second home down in Florida, or quite frankly, just being able to pay the bills and to live their retirement without having income coming in from their jobs that they work so hard for overall their careers. So that's a little background on myself, Jack. Hopefully that was helpful in putting in perspective where I started, where I am. And I'd be more than happy to take any questions that you guys have about Hennion Walsh, what we do, how we do it, or any questions you have about just the market or the economy in general.
Yeah, I think some of our members, I think from where I'm looking at here, half of you I know that went to last year, I think last semester when you came in. But can you explain for the rest of our members who were not there, can you explain what Hennion Walsh is and what do you guys do on a day-to-day basis?
Certainly. So Hennion Walsh was started back in 1990, primarily as an individual or an advocate rather for the individual investor. We focus primarily on fixed income investments, notably municipal bonds. However, we do operate in three distinct divisions. You can see those three divisions on the wall behind me here with the three logos of those three divisions, which we always refer to as the three-legged stool here. So Hennion Walsh Incorporated is that full service independent broker dealer that services and caters to the individual investors, helping them meet all of their individual investment needs. Hennion Walsh Asset Management, which you'll see in the other corner there, is a registered investment advisor. Through that registered investment advisor, we develop and manage discretionary model portfolios comprised almost exclusively of exchange traded funds to help our clients meet either their growth or their income objectives. As part of that solution, which we call comprehensive wealth management, we add to the investment management capabilities, financial planning, estate planning, and insurance as well. So that's Hennion Walsh Asset Management. And then finally, the third leg of the stool is SmartTrust. You can see our tagline there, innovative, independent, UIT focused. If you're not familiar with UITs, a UIT is another 1940 Act product, similar to an open-ended mutual fund or an exchange traded fund. The primary difference with a UIT is that it's outstanding for a defined period of time, generally 15 months or 24 months, and the securities in the portfolio generally remain static over the life of the trust. We have 27 different UIT strategies. Some of those strategies are thematic in nature. We have a sustainable impact investing trust. We have a technology revolution trust that invests in areas such as artificial intelligence, robotics, blockchain. We have a healthcare innovations trust that focuses on biotech M&A opportunities. We have some more traditional dividend paying strategies. So again, it really allows for a wide gamut of different investment strategies and themes to be built into a packaged product that can be sold through financial advisors to their individual clients. So three different legs on the stool, each one ultimately providing investment solutions to the individual investor, either through a financial advisor or directly through to the individual client.
All right. So I know there was a couple of people that could not make tonight, but they did ask me to ask you some questions that I have here on the list here. So what were some of the biggest challenges you have faced as the president and CIO of Hennion Walsh Asset Management, and how have you overcome them in your career?
I think the biggest challenge that we have in financial services as a whole is trying to prevent the individual investor from doing harm unto themselves. Our role is to kind of take their hand and guide them through those dark tunnels to the light on the other side, because there is always light on the other side. We remember back in 2008, during the great financial crisis, that we all thought the world was coming to an end. Well, guess what happened in March of 2009? The market recovered, the economy recovered, and the markets recovered. We think back to just last year in 2022, when we saw the most difficult first half of a year for the stock market in nearly 52 years. We saw the most difficult first quarter for municipal bonds in over 40 years. A lot of investors, when they're faced with that type of volatility, they try and become market timers. They get scared. They rush to the sidelines. You know what the problem with trying to time the market, Jack, is? You have to be right not once, but twice. You have to know when to get out and when to get back in again. And based upon our research over the last 25 years, had you just missed out on the 10 best days in the market, just the 10 best days in the market over the last 25 years, your returns would have been cut in half. So what we try and do with our clients, those individual investors, is develop a longer-term financial plan. Make that plan consistent with their own tolerance for risk. Their tolerance for risk shouldn't go up when markets are doing well, just as much as it shouldn't necessarily go down when markets are not doing well. They should be true to their risk tolerance. We also want to understand what their overall investment time frame is, and specifically what their growth and their income needs are. Once we develop that plan and we could start tracking their success towards that longer term plan, all of a sudden they don't really care as much about what CNBC is saying during the day, what Jim Cramer is touting today, or what the S&P or the Dow did on a given day. They're more concerned with, hey, am I still on track to meet my longer term goals and objectives? And that's where we find the greatest benefit in what we do. But it's very, very challenging because our clients are faced with the 24/7 news cycle, and that news cycle is constantly trying to sell fear and despair. We have to put that fear and despair into perspective, because some of that fear is real and it's founded in fact, but you have to put it into the historical context and position your portfolios accordingly for what we think is going to come ahead as a result of what happened before. I had a great conversation last week. I was out in Texas. I was with clients in San Antonio the beginning part of the week and in Houston the latter part of the week. And one of the clients that we spoke with was in one of our portfolios, our tax-free income trust, that was down in value last year. It was down about 23% over the course of the year. And he said, where can I put that money today to make that back as quickly as possible? And I said, quite frankly, well, if you had that money a year ago, where would you have put that money then? He goes, well, I had no idea. Exactly. We can't reinvest that money for what happened already. But you know what we can do? We can position it going forward based upon the information that we have today that we believe will provide you with the greatest potential to achieve whatever your goals and objectives are. And that puts a whole different perspective on that type of question. Not why did you invest me where I did, but where should I be investing going forward? And that's often what causes us the greatest angst and gives me the most gray hair. But when clients do get it, and when they ultimately achieve their longer term investment goals and objectives, they might even thank you.
That's great. The next question I have here on my list. So with the COVID-19 pandemic, which obviously disrupted the global economy, what do you think would be the long-term effects on the market, and how should investors adjust their strategy?
We built a strategy here at SmartTrust, Jack, as a result of COVID-19. We call the strategy the New American Economy Trust. And we believe that there are, in particular, 3 different areas of the U.S. economy that's going to lead the U.S. economy forward, coming out of the pandemic and also coming out of this most recent downturn, where interest rates were raised by 450 basis points in the matter of 1 year to help combat record-setting levels of inflation, which were the direct cause of all the money that was injected into the system during the pandemic. Those 3 sectors, of course, are information technology, consumer discretionary, notably e-commerce, and lastly, healthcare. I really believe if you position your portfolios in quality-oriented companies, and by quality, I mean those with strong balance sheets, low debt-to-asset ratios, those that actually have free cash flow, that pay a dividend, have a history of increasing their dividends, have a history of growing their earnings through good and bad economies, and are associated with one of those 3 sectors, you're going to find that those same companies are going to provide the leadership to your portfolios as well. You think about the technology side of it. What COVID taught us is that we can all truly be fully functional, working remotely, working hybrid, or working in the offices, thanks to all the innovation we've seen in technology. And some of those areas may actually include, as we're finding out, artificial intelligence, robotics, fintech, the Internet of Things, cybersecurity. I always refer to cybersecurity as the glue that holds the technology puzzle together. Blockchain, not cryptocurrencies, but the actual technology that cryptocurrencies and many other industry-leading financial technologies are built on top of. How can companies survive without adopting these types of technology? And if you can find those companies that have adopted that technology and possess those other selection criteria I alluded to earlier, that seems like good investments. On the e-commerce side, America has already made their preference. They like to shop online. They like the convenience of online shopping. They like the price points of online shopping, and they like the ability to get what they want when they want it in a short period of time. We're a society of now. We're not a society of wait until it comes later, and e-commerce fits that bill. But you can't just limit yourself to those traditional e-commerce companies, because there are many other companies that also derive benefits from the roles they play in the e-commerce ecosystem. Think about it this way. If you just go through the anatomy of an online sale, right? You pick up your phone, you bring up Google, you type in the product you're looking for, the merchant you're looking for, it comes up on your phone. You find the item you want, you find the size you want, you put in your credit card details, you send off the order. Merchant then gets that order. He then goes down to his warehouse, finds that item, puts it on a truck, goes to a distribution center, ultimately gets sent to your end location, delivered to your front door, and the payment is consummated. One transaction, think about how many different companies and industries that affected. That affected potentially FedEx, UPS, that affected Visa, MasterCard, PayPal, that impacted some REITs or industrial warehouses. You might have, if you've driven down a New Jersey Turnpike, you've probably seen Prologis, those gigantic football-sized buildings. That's a key component to the e-commerce ecosystem. Alphabet, that search engine, Dell, Apple, key components to the e-commerce ecosystem. A company like Fiserv, which connects the merchants to the credit card companies to facilitate that payment online, key component to the e-commerce ecosystem. And then, of course, you have the Amazons, the eBays, the Etsy's, the 1-800-Flowers that really derive benefit from e-commerce. But we think that's another area that's going to lead this economy forward coming out of COVID. And then lastly, healthcare. Society has never been as focused on healthcare as we are now coming out of the pandemic. But unfortunately, Jack, there are many other rare and chronic diseases that still exist and do not have therapeutics, much less cures for. And generally, those cures come from not the large cap pharmaceutical companies, but rather the smaller cap biotech companies. Just think about the 3 vaccines we had. 2 of them were developed by biotech companies. Johnson & Johnson was actually developed by Janssen, a smaller cap biotech company. Pfizer's vaccine was developed by BioNTech, the German biotech company. So biotech is where all the medical innovation is coming from in our country, whether it's gene editing, gene splicing, immunotherapies, CAR-T, CRISPR. We've all heard of these groundbreaking, innovative medical approaches, and it's the smaller cap biotech companies that are developing them, and it's the larger cap pharmaceutical companies that are acquiring them. So that's the investment opportunity that we see.
Okay. So with the rise of passive investing in index funds, how does active management fit into the modern investment landscape, and what advantages and disadvantages does it offer?
Sure. And I don't think you necessarily have to choose one over the other. For example, we run 14 different model portfolios here at Hennion Walsh Management. Those model portfolios are comprised exclusively of passively managed ETFs. But guess what? The manner in which we allocate to those passively managed ETFs and the manner in which we tactically change those portfolios is actively managed. So we're an active manager that uses passively managed exchange traded products to implement our overall asset allocation framework. It is the best of both worlds, because if I want to allocate and I have a view, for example, we recently increased our allocation to international developed market equities. We did that because what we noticed is back in October, the US dollar hit peak value as a result of the Fed now starting to slow down the pace of their interest rate increases, which I believe will come to a halt very soon. Once that started to take place and the rest of the world was still raising interest rates, the dollar fell in value. When the dollar fell in value, international stocks started to outperform US stocks and have continued to thus far in 2023. So I want to invest or add allocations into international developed market equities, but I don't want to risk that money on an active manager who 70% of the time is going to underperform the market or their benchmark and do it for much higher expenses. So I want to allocate towards a passive product that's low expense, is transparent, and allows me the ability to get in and out very efficiently. So if anyone does ask you going forward, or once you do start working in the real world, are you more passive or are you more active? You don't necessarily have to be one or the other. You can blend elements of both.
Righty. So there are a lot of different asset classes out there, but how would you personally evaluate them? And what criteria do you use to determine which investments are the most promising to be put into a portfolio?
It's a great question. So I spoke about those 14 different, actually 18 different model portfolios that we have made up of ETFs. 14 of those are target risk in nature. If you're not familiar with what target risk models are, what they do, they're designed to stay within a certain band of risk for a defined period of time. And if you learn modern portfolio theory, the efficient market hypothesis, what we do is that we actually plot the potential outcomes of different asset classes along that curve to try and build portfolios that have the maximum potential return given a stated level of risk. And what falls out of that is the different asset classes that we can use to help achieve that total outcome. So we have 7 different target risk portfolios that range in risk tolerance complexion from enhanced growth all the way down to conservative. Then we have what we call more thematic model portfolios. One is our US equity opportunities portfolio. We have a global equity opportunities portfolio, a diversified income portfolio, and then a tax-advantaged income portfolio. For those, we're trying to achieve specified objectives, such as only investing in US stocks, investing in global stocks, investing in securities that can provide tax-advantaged income, such as dividend-paying stocks or municipal bonds, or just a diversified income portfolio that could allow us to invest in areas such as preferred stocks, convertible bonds, REITs, and other income-producing investments. So it's really the objective of the portfolio that leads to the asset classes that we'll consider. But generally, it all breaks down in terms of equities, fixed income, and cash equivalents, and occasionally commodities. And then within each one of those major asset classes, you'll get into sub-asset classes by things such as market cap or style, large cap value, growth, blend, and the like. And in certain cases, we'll even give overweights to sectors such as healthcare or technology or consumer discretionary, as I alluded to earlier.
All righty. So with interest rates now at a historic low, how do you see fixed income investments performing in the coming years? And what strategies do you recommend for investors looking to generate income?
Yeah, I mean, if you would have asked me that question back in February, I would have agreed that they're at historic lows, because at that point in time, the Fed funds target rate was in a range of 0 to 25 basis points. Today, just a little over a year later, they're in a range of 4.75% to 5%. And as it stands right now, we still have an inverted yield curve. An inverted yield curve means that short-term rates are currently yielding more than longer-term rates, specifically between the 2 and the 10-year. So most investors would prefer to take less duration and invest in the 2-year when they're getting more yield from it than going out 10 years and getting less yield for that. However, we've now hit a point where I believe the Fed can no longer aggressively raise interest rates to help combat inflation because something has broken the system. You may have heard the recent collapse of SVB Bank, Signature Bank, or the forced acquisition of Credit Suisse by UBS over in Switzerland. That was largely a byproduct of this dramatic move higher in interest rates, which caused fixed income securities such as bonds to go down in value. Remember the inverse relationship between pricing yields with fixed income instruments. As interest rates or yields go higher, prices go down. When interest rates or yields go lower, prices move higher. So all these banks had treasuries sitting on their balance sheets that were going down in value as yields went up. That broke the system. So I believe that the Fed can no longer move. They might move one more time by 25 basis points in May, but they're going to have to stop there and assess the overall amount of damage they've done to the economy. That creates opportunities for both stocks and for bonds looking ahead. Such areas as those that were really beaten up on the sector side of equities in 2022, and those that were most impacted by rising rates, technology, communication services, discretionary, should benefit the most from a rebound. And then I look at an asset class such as municipal bonds, which also suffered significantly in 2022 as rates went up and prices went down. They're going to be very well poised for a rebound, not only because investors still demand and crave tax-free income, but because the supply of municipal debt is coming down. And if demand goes up and supply comes down, prices should move higher as well. And then also think about this. If in fact you were a municipality today and you had to issue new debt and you saw that short-term yields were at 5%, but you also looked out at the forward-looking yield curve and you saw it just in 2 years that those are coming down to 3%, you'd probably wait, right? So that creates the opportunity that we see. All these municipalities are likely going to wait to issue debt when yields come down. And as a result, there's going to be even less supply. So we see opportunities in bonds as it relates to municipal bonds or municipal bond closed-end funds, and those sectors of equities that were beaten up the most in 2022 and impacted the most by rising interest rates, benefiting from the end of this rate hike cycle.
All righty. So as the world now becomes more interconnected and globalized, how do geopolitical events impact investment decisions, and what steps can investors take to mitigate those risks? Or in all cases, I think everyone in this room probably agrees with me on this, eliminate these risks altogether so you don't even have to worry about it.
Yeah, I wish I could have an answer to that. You know, I was asked a question by a producer at CNBC the other day. What keeps you up at night? What's your biggest concern right now in the markets? And it's always the fear of what you don't know, that big macro shock that could be created by the announcement of, for example, China invading Taiwan, Russia invading Ukraine, a terrorist event that pulls in multiple countries and has supply chain disruptions associated with them, a global pandemic that causes everybody to stay inside for over 2 years. These are things that portfolio managers cannot account for, and it's very difficult to position for. But what we can do is remain active and see how markets and the economy reacts to those types of events. Always staying consistent with each individual investor's risk tolerance, investment timeframes, and growth and income objectives, because we know at the end of that longer term financial plan, they still want to meet that longer term financial goal. And we can't keep looking at things in terms of macro geopolitical events, months, quarters, or years. We have to look at a longer duration, a longer time frame when we're managing client portfolios. But there's many different tools that we have that can provide downside protection. We came out with another new strategy here in 2023, which we call the Power 50 Equities and Covered Call Trust. If you're not familiar with covered calls, it's essentially you're buying a stock, selling off the upside potential of it, and taking in some income. So you have a little bit of upside growth potential, but you've mitigated the downside risk and taken in some income along the way. That could be a good way to hedge some stock market risk. You can also invest in different areas of the stock market that are generally less volatile during periods of heightened volatility, or sectors that have historically performed well during economic slowdowns or recessions. such as consumer staples or utilities or even healthcare. And then fixed income generally benefits from the flight to safety, US Treasuries, in some cases, some commodities like gold. So there are different tools and asset classes that we can use within our investment portfolios to help mitigate the damage when a geopolitical event does occur. But you have to remain nimble to be able to react to the unknown things that do unfold.
So I think in our club here, I know we brought in, we brought in this semester, we brought in a company that does specialize in ESG investing. So with the increased popularity of sustainable investing, how do you assess the ESG, environmental, social governance factors when evaluating potential investments? And what role do you see for ESG in the future of investing?
Yes, and unfortunately, ESG has become a 4-letter word for a 3-letter acronym and become very politicized over the course of the last year. I think that's primarily because of the E, not necessarily the S and the G, and the focus and the debate in the halls of Congress over climate change. But if you look at some of the underlying tenets of ESG, they really can help a portfolio manager like myself find good companies that treat their employees right, that give back to their communities, and should be able to retain their most valuable resource they have. That's their people, their talented people that help their companies grow. And I don't know if ESG is the right way to get at those types of answers. ESG often are these black box rating systems that rate companies based upon some arcane way of looking at those different metrics and might weight them in ways that you don't necessarily agree with or understand. We're very fortunate at SmartTrust to work with a company called Just Capital. If you haven't heard of Just Capital, they're led by Martin Whitaker. On their board are luminaries such as Paul Tudor Jones, Arianna Huffington, Deepak Chopra, and they take a very different approach to trying to get at the very thing that ESG was originally trying to accomplish. We do it and we call it our Sustainable Impact Investing Trust. What Just Capital does is they go out and they poll individual Americans and ask them to rank and prioritize what factors they feel are most important to determine what corporations are acting justly. And they divide them up across 5 different stakeholder categories, those categories being their employees, their clients, the communities they operate within, the environment, and also shareholders. We can't leave shareholders out of the equation. Remember, sustainable impact investing should marry your investors' beliefs over investing in companies they can feel good about, but also investing in the stocks of those companies that their portfolios can feel good about as well. Based upon Just rating system, which they debut in January of each year and publish the top 100 Just companies in the country and actually announce those on CNBC, what we found is Americans, how they rank those 5 different stakeholder categories, number 1 to Americans with the majority of the weighting is how companies treat their employees. Number 2 was how philanthropic they are. Do they give back to the communities they operate within? Last on that list of 5 stakeholder categories, interestingly enough, was the environment, with just a 9% weighting. Not that Americans don't care about the environment, certainly they do, but in evaluating the just behavior of companies and companies that they want to invest in that they think can grow their capital, they felt those other factors were more important. Once you have the basis for your rating system, it can't stop there. You then need to look at the investment merits of the company, and we work with Argus Research Company to develop the investment merits of the company. So those companies that have the highest Just Capital ratings are then vetted through the equity research analysts at Argus Research to ensure that those with the highest ratings have to have a buy rating from the research analysts as well. And combined, you get that holistic, sustainable impact investing solution. I think that's the path forward for ESG. And I think eventually, Jack, we're going to get to a point where we're no longer talking about ESG or sustainable impact investing. And those selection criteria just become part of all portfolios manager process in trying to find the best companies to invest in.
All right. I think Joe has a question. I don't know, Joe, you want to mute yourself? You can ask your question. You can.
Sure. If, I mean, this is, I don't know if you can provide us the answer to this question, but if you had to pick like 3 stocks that you think are gonna boom within like the next year or so, do you have like any companies that you think would boom in the next year?
I- I'll give you an example of from those 3 sectors that I spoke about earlier that I believe are going to lead the American economy forward coming out of COVID-19 and also coming out of this dramatic interest rate hike cycle that we've seen over the last year. Remember, those sectors were technology, consumer discretionary, notably e-commerce, and then healthcare. These 3 companies we do have investments in within our New American Economy Trust. I'm not telling you they're the best 3. I'm not telling you these are the 3 that are going to grow the most, but these are just 3 examples. So on the technology side, Broadcom is one. Clearly, companies cannot survive in the modern world without infrastructure solution and semiconductor capabilities. Broadcom pays a nice dividend, nearly 3% free cash flow on their balance sheet, trading at attractive valuation. On the consumer discretionary side, Dick's Sporting Goods, they have a dividend yield of nearly 2%, debt to asset ratios below 50%, positive free cash flow. I think their forward valuation is only 11 right now, and our country is sports mad. And coming out of the pandemic, again, we're more hyper-focused on health and wellness than we ever were before, and Dick's Sporting Goods is certainly filling the need as it relates to sporting equipment, apparel, and sporting goods as well. And they continue to grow out their online footprint to complement their in-store sales that they have across the country. And then on the healthcare side, we like companies such as Merck on the large cap pharmaceutical side. A larger cap biotech name that we have in the portfolio is Regeneron Pharmaceuticals. And there's a whole host of other smaller cap biotech names that we've invested into that we think possess takeover attributes that could make them an attractive investment over the next 2 years as well. But those are just 3 names that we hold right now within those 3 different sectors that I think should drive the economy forward.
Thank you.
You're welcome, Joe.
All right. We got another question here. They didn't want to. You told me about. You just told me. I think me and you were talking about it earlier. I think today. I remember. With the recent surge in cryptocurrency prices, how do you see the digital assets fitting into the broader investment landscape, and what risks and opportunities should investors be aware of? Because I know when we have our markets update every Tuesday, I know John Budish usually tells us, I really don't want to deal with crypto. I don't know about it. You got to tell me like I'm a toddler, like I'm a 2-year-old. You got to explain to me like that. And we don't do that in our student managed investment fund. We don't even invest in crypto. So we were like, why is this? But, how would you see the digital assets fitting into the broader investment landscape?
2 biggest risks that I see to digital assets. One, if you can't explain to yourself or the client that you've invested their hard money into why it's going up in value in a given day or why it's going down in value in a given day, you're in trouble. And I've been doing this 30 years. I've never invested clients' money or my own money in an investment that I didn't fully understand or have conviction with. I've been wrong plenty of times, but I have a fundamental basis for the belief in why I'm investing in that sector, in that company, in that asset class at that time. I don't understand cryptocurrencies well enough. I know it's a limited function of supply and available Bitcoin in the example of Bitcoin, but I don't understand the mechanics well enough to get my arms around feeling comfortable allocating capital to it. That's one risk. Second risk I see is the risk of regulation. And ultimately, I still believe that the US government and other central banks will have their own digital currency. Once they have their own digital currency, they're going to block out all the other digital currencies by putting more regulations and ring fences around them. So that's the other risk I see overall with cryptocurrencies or digital currencies. But I still am very impressed and see tremendous applicability with the underlying technology that they're all based on, and that's blockchain. Whether it's, currency transactions, fintech, medical payments, the healthcare industry, blockchain is transformative, and more companies are embracing it. Remember, IBM was the first one to actually start using and implementing blockchain, and now it's being spread out and used by a wide variety of different technology companies. So I think that's the real opportunity for investment that I see, and I'm very dubious about cryptocurrencies as a whole.
Now, even speaking about technology, with the rise of ChatGPT, I know some of you in this room, I know, use it. I even know I don't use it at all here. How do you see technology impacting the financial industry, and what role do you think artificial intelligence and machine learning like ChatGPT, OpenAI as an example, will play into investment management?
I think it's going to become more and more of a critical element to it. The ability for myself and my research team to access large amounts of data, analyze large amounts of data to make rational investment decisions with, is what we do every single day. If artificial intelligence, I don't know if ChatGPT is necessarily the answer, but artificial intelligence can help speed up that process, make it more efficient, make it more effective, make it more repeatable and scalable, well, then I think that's transformative. I don't think we're there just yet. I do like Microsoft because of all the work that they're doing in that space right now. I think companies such as Microsoft, Apple last year sold off far more than they should have, and they're going to continue to be the innovators that our economy needs moving forward. And I think that ChatGPT is just one example of the innovation that we continue to see from the United States, and one reason I would never bet against the US.
Certainly. So what are some key lessons that you have learned throughout your career in asset management, and how have they shaped your investment philosophy?
I guess the biggest one is that don't be afraid to admit when you're wrong, and don't be afraid to be wrong. Sometimes you really have to surround yourself with people or information that is the polar opposite of what you believe, or information that you have already. Because if you put blinders on in this industry and you think you know it all, you're going to be bound to fail miserably. And it's okay to fail, but it's not okay to not admit those failures and not learn from those failures. The second thing, and just in terms of the best advice I could give to all of you right now, is don't be so hyper concerned with that first job being your last job or your best job. Remember, I want to be an architect. I started in a management training program. I was in the operations role. I moved into risk management and eventually found my way into wealth management, and later became the president and CIO of a wealth management firm. But it didn't start there. The steps along the way is what makes the journey so enjoyable and really builds you into a well-rounded businessman or woman that could truly succeed in the long run. So many students that I speak to, they want the right job. They're going to wait. There's nothing good right now. I don't like this role. So go work somewhere else. The first job doesn't have to be your last job, but it can be a stepping stone. But don't give up on it too quickly. You may find that you get exposed to a different manager, a different group, or a different function, or a different element of the business that really appeals to you and really hits at what your talents are. So be open-minded, don't be afraid to fail, and don't think that your first job has to be your last job.
All right. So does anyone have any other questions before I ask my questions? Because I know I just round off a list of them of great questions that our members that could not be here tonight. Anybody here? All right. I guess I'll ask my questions. So I think most of you probably know the question about to ask right now. So basically with like certifications, like the CFP exam and even the CFA exam, I have heard from like multiple people that have came to this club, I've asked them the same question about, do you feel like in the wealth management industry, do you feel like you need to get your CFP or your CFA or get both? I have heard from like our other speakers, like one of them has said, oh, get the CFP, others get CFA, others get both. But what, in your opinion, would you feel like would be the best like path to go down? Do CFP, do CFA, do both? Like, what's your take on it?
So, you know my background, you know the role that I have here, doing it for 30 years. I'm in the media regularly. I've had a book published. I write for Forbes. I'm pretty well known across Wall Street. I don't have a CFA. I don't have a CFP. I have an MBA from FDU. And I also have a tremendous network of resources that I can tap into across Wall Street to help me answer questions, because I'm not afraid to admit when I don't know something or when I'm wrong. What I will tell you, though, is to be effective in our role, once you get onto Wall Street, you have to obviously get a Series 7 to be able to sell securities to members of the general public. I'd highly recommend once you get to a firm, you get your Series 65 and 63, which allows you to also manage money on a discretionary basis. They combine those two now into a Series 66. The way that we approach wealth management at Hennion Walsh is we develop a team of experts we call comprehensive wealth management. We have individuals on my team that only do financial plans. They're experts in financial planning and estate planning. They all have CFPs. On my investment team, so we have an investment committee here that supports and reports into me as the CIO to develop all of our managed money portfolios and all of the 27 UIT portfolios that we have. Each one of those members, we encourage to get their CFAs, because I think that 3-part test really does develop and hone their abilities to look at and analyze companies from both a macro, quantitative, and a qualitative perspective. Now, so if you're going to be a financial advisor, none of our financial advisors have CFAs or CFPs. They're relationship managers. They're good salespeople. They have high integrity. They know how to present solutions to clients' problems, and they pull in experts when they need it, whether it's the financial planning expert, whether it's the investment management expert who's got the CFA, or it's someone who's an attorney for estate planning or provides insurance solutions. You don't have to be all things to all people. What I think you get the most benefit from, probably the CFA, just from an investment management perspective. What's in the highest demand right now are CFPs. And they're very difficult to find, and they're very difficult to keep. So if you have that level of expertise and that certification, you'll have more job opportunities to consider. Just don't know if they're the job opportunities that everybody wants.
Yeah, that's great. I probably think everyone probably would ask this. What was your favorite FDU silver moment when you were at FDU?
So when I was at FDU, remember I had the graduate business fellowship. I worked in the Department of Academic Advising at that time for Dr. Lois Malone. And students would come, I was a student. Granted, I was 22 years old. I already graduated with my undergraduate degree, but they would come in for guidance with respect to academic advising and what courses they had to take and credits they had to fulfill to actually graduate. And computers were very rudimentary back then. So we had these dot matrix printouts of all the courses that you had to go to find what courses they could get into. You'd handwrite how many people in the class, how many spots were open. And I could just think how little training I got at that time, but how incredibly important that was, that I gave those students the right information so that they could graduate on time. And when those students later came back and said, I got into that class, you know what? I never thought I could have taken that and still graduated. That was a good elective. Boy, did that feel good helping somebody. So I think that's what drove me towards the financial advisory side of Wall Street, because you can directly impact and help somebody achieve what they want to. At FDU, it was graduating. On Wall Street, it's actually helping people fulfill their financial goals and dreams. But when you can actually have an impact and help someone and they came back later and say, thank you, God, there's no better feeling, aside from all the money.
Does anyone else have any other final questions for Kevin before I ask the final question? No? You guys can tell me, you guys come up here and ask me. You guys don't have to be afraid. All right. All right. I guess I'll ask the final question. It's going to be a two-parter because I do know in this room, we do have a couple of freshmen, a couple of sophomores, just by recognizing the faces here. But basically, what would be the best piece of advice you would give to an undergraduate, like freshman or sophomore, who hasn't really decided yet what path they want to go down? They want to go down accounting or finance or wealth management. And then the second part of that question, actually, there's three parts. I'm sorry. Second part of that, what advice would you give to young professionals like us, obviously, who are in this meeting tonight, who are just starting to invest, and what key principles should you keep in mind as they build their portfolios? And then the last question would be is, if you had to go back to your past self back in college, what would be the one thing you would want to tell your past self to change, that you want to do different?
Yeah, it's three parts.
Yes.
So the first part, for all the freshmen there who are trying to find their way and determine what they ultimately want to be when they grow up, right? I would suggest that you read. There's no better source of information than through the power of reading. That now, reading doesn't necessarily have to be through books either. There's so many different ways now that we can gain access to information. So start by researching and reading. Second, network. Talk to people who are either in those majors that you're considering or perhaps who work in those fields. Get a feel for what they actually do every day. You may think you know what accounting is, but do you really just want to be balancing ledgers each and every day for the rest of your life? Or do you prefer just to look at the balance sheets of companies to analyze who's good and who's bad, ultimately to make an investment decision or to help steer a mergers and acquisition types of conversation? And then lastly, take a wide variety of different courses. Don't assume you know what you want to do now. I went through 4 years of Muhlenberg College. I got my degree in business administration. I didn't know exactly what I wanted to do. Remember, I thought I wanted to be the architect. I found out I couldn't draw. I wasn't good at it. Got my degree in business administration. I thought at that time I would go and work on Wall Street. Didn't know exactly what I wanted to do on Wall Street. Went to FDU. I got the fellowship. I started to hone in on my MBA in finance, read the book Liar's Poker, and knew that I wanted to be on Wall Street. That just drove me. And I thought I wanted to be an equity research analyst until I spoke to a few people and found out what they did every day. And I said, A, that's not lined up with my talents or my personality. And B, after a week of that, I'd leave. So I was very fortunate to talk to people, network, get information, do some research. And then I got into that management training program where I rotated among different desks and ultimately found out the areas that fit my personality and my skill type and my talents. And then I grew from there. So those would be my recommendations for finding your way. One of your other questions were, how do you invest a portfolio? What tenants do you use? Many people often say you build wealth through concentrations, you maintain your wealth through diversification. I'm a very conservative investor by nature. I feel very uncomfortable with concentrated positions. In other words, I'm not just going to pick a portfolio of 3 to 5 stocks. One of the other companies I like overall, and I think traded off too much last year, bounced back this year, is Amazon. I often refer to the Amazonification of the US economy, and they continue to spread their tentacles into different industries. But I feel very uncomfortable investing a large amount of my money in any one name because we never really know everything about any company, no matter how much you analyze it. So I believe diversification is the best way to achieve that. You can do that by investing in a diversified portfolio of exchange traded funds. Maybe you sprinkle in a couple of overweights and a couple of stocks, but keep to those overlying asset classes and ETFs that are very transparent, give you the diversification, and also do it at a very low cost basis. So if 80% of your portfolio is in ETFs, then you have 4 or 5 other stocks that make that 20% overweight. You could still follow and build well through the concentrations, but you have that ballast through the diversification using the ETFs. Last question was, My former self, what would I do differently? I don't know if I'd do anything. I wish I didn't have all this gray hair right now. I wish I would have kept playing basketball throughout all 4 years at college, but I think everything that I did ultimately led me to where I was today. Do I wish I would have gotten here quicker? Sure. But there's no one recipe to success in this life. So if you're not afraid to fail, if you continue to ask questions and network, you continue to read, and you put yourself in a position to succeed, I think everyone has a shot at success, whether it's on Wall Street or not.
Well, I believe that was an amazing meeting we had here today. Thank you so much, Kevin, for coming in and speaking to us.
My pleasure, Jack.
I really hope everyone after this meeting go connect with him on LinkedIn. Please do so. And then, yeah, with that, that is it. Thank you so much, Kevin, for coming and speak to us today.
My pleasure. Have a great night, everybody.
You too. Thank you.
Turn it on.